Wonderful. I think we'll get started. It sounds like folks are gathering. I want to welcome Charlie and welcome to everyone joining today at MassCEC and beyond. I'm excited to launch this Climate Tech Speaker Series. We'll be highlighting experts, pioneers, and practitioners from a variety of existing and emerging climate tech sectors and disciplines, as well as subject matter experts who can provide insights into broader economic, social, and technological dynamics shaping our industry. So today we're going to focus on climate-related insurance products, specifically community-embedded insurance. And Charlie Sidoti, who joins us today with Insure, will share his experience and knowledge. Charlie brings 35 plus years in the insurance industry, including underwriting, engineering, and risk management related leadership roles with property and casualty insurance carriers, and experience leading risk assessment focused insurtech startups. Charlie is currently founder and chief executive of Insure, a mission-driven nonprofit focused on catalyzing a bold insurance response to climate change. But before we turn to Charlie, I wanted to provide a bit of context because I think for many, the connection between insurance and climate tech, climate policy, and climate progress may be a bit fuzzy. Perhaps more of us are aware of the need for innovative climate finance products to support climate work. Many of you may be aware that the Healey administration launched the Massachusetts Community Climate Bank in 2023. It launched its first product last year in 2024, a loan for affordable housing building decarbonization. Happy to share that MassCEC actually played a role in standing up the state's first climate bank. Climate finance institutions like the Mass Community Climate Bank may offer more patient or lower interest capital to encourage home and business owner adoption of climate technologies, either on their own or blended with traditional finance products. So climate projects, whether they be mitigation, adaptation, or resilience related, may need financing, but of course, all project finance involves risk, whether that be technology risk, borrower or credit risk, market risk, or other risk classes, including federal government clean energy incentive and tax credit risk. So increasingly, climate practitioners are realizing that novel insurance products could help address some or all of these types of risk, because of course, that is the function that insurance performs. It manages risk. So for us here at MassCEC, I can remember early conversations with MassCEC colleague Kelsey Reed on this topic, who played a key role in designing and managing the solar loan program that MassCEC administered. We had set aside a little over $5 million in a loan loss reserve to protect participating solar lenders, mostly small banks across the state, from loan defaults. But I remember discussing with Kelsey at that time, in the future, could we address that default risk with a novel insurance product that might be substantially more capital efficient than a loan loss reserve? More recently, we've supported at least one Massachusetts-based company in this space, Energetic Insurance, which develops bespoke insurance products to support mid-market commercial solar PV project finance. And then more recently, still, we discussed with a rapidly growing Massachusetts-based climate tech company the desire for an insurance product to address insolvency risk as they move to land their first customer. So this is really a rapidly evolving space. I also want to acknowledge an excellent event on this topic recently convened by the Massachusetts Climate Office, by Chief Hoffer, the City of Boston, and the Green Ribbon Commission. It was great to see you there, Charlie. I thought that was a really good event that I think drew a wide variety of stakeholders, including a lot of big brand insurers. So Charlie, you're our inaugural presenter. Thanks again for sharing your time and expertise with us. We're going to have a conversation, cover some territory, and then we'll open it up to all of you on the webinar. So please use for all of you listening, please use welcome, and please use the Q&A function, and feel free to drop in questions at any time, although we'll hold off on addressing them until the end. We also have a couple of poll questions that we intend to make available to you, to pose to all of you. We'll do that toward the end of the discussion. So thanks again for joining us, Charlie. Let's set the table a bit. If you could just talk about Insure, why does it exist, and what problem are you trying to solve?
Sure. Thank you so much. I mean, we really appreciate the opportunity, especially on the inaugural event. But also all the work you do and some of the comments you said are exactly right. The transition can only move as fast as we can manage the risks, and risk management and insurance are required for that. And then there's other challenges, which we'll talk about as we go through the session. But again, I am Charlie Sidoti, and I am the executive director of Insure. Insure is as Galen said, a nonprofit focused on this intersection of climate tech and insure tech and climate insurance and de-risking the transition. We believe that insurance is one of the most effective and efficient ways to finance risk related to both the energy transition, but also on the impacts of catastrophes, which we're going to talk about. And the insurance industry is having a difficult time in both of these areas. Uh, the energy transition in innovation is going very quickly, driven a lot by what MassCEC does and others, probably a lot of the people on this call. And insurance is not a super efficient innovator, so it's having difficulty keeping up with the evolving risks that come along with the innovation that's happening related to transitioning to a low carbon economy. And on the flip side, climate is changing and the impacts are flowing through. Just some of the recent storms, the Helene and Milton on the hurricane front, and obviously the terrible fires that are going on in California right now are both, at least in part, kind of contributed to climate change. So those are both difficult things for the industry to deal with, and we are dedicated to really kind of creating insurance markets that work, but not just for the insurance companies, but work for everybody. And our goal is really to make insurance accessible, affordably, and widely adopted. We think it needs to be in the hands of people that have risks, whether they're individuals or enterprises or even communities in this time of climate change. And that means not just innovating insurance, but also innovating the risks and the risk control kind of factors, the adaptation measures, whether they're at a community level related to the hazards like hurricane and wildfire, or at a kind of innovation level, a product level when it comes to new technologies coming into the market. And we believe that a lot needs to happen in insurance. It's not just tinkering around the edges. Some of the losses during Hurricane Helene, less than 25% of the catastrophe damage was covered by insurance. That's really not a good number. And so we think some significant kind of reimagining of how insurance is delivered is necessary, and we are promoting and supporting the innovation necessary to do that. And essentially that translates into what we call our four measurable pillars of impact, which is really closing these protection gaps where there are gaps in insurance, often related to risk or price or accessibility. So how do we close those protection gaps in ways that they accelerate the adoption of technology that is promoting a transition to a low carbon economy? How do they drive, incentivize community resilience? And part of that on both fronts is how can they promote nature positive practices? So we're trying to create better insurance products and services that deliver these impacts for the world. We really look at everything through the lens of what does the world need from insurance, which we also think can be a good business. And that translates into some programs. What do we actually do? We run incubation and acceleration programs and challenges, and we're going to talk about one that we're doing for the state of New York, NYSERDA, New York State Energy Research Development Authority, We also do local demonstration projects and planning projects. How do you incorporate insurability into community economic development planning so that these risks, and not just the risks, but how to make the community more insurable, is part of the planning process, which is better for the projects, better for the community over the long haul. And both of those require a broad ecosystem of innovators and academics and solution providers that really cut across kind of finance projects and on both sides, adaptation projects, but also energy transition related technology and project developers. That's kind of what we do at a high level, and I'll kind of stop there and we can kind of dig deeper.
Yeah, thanks, Charlie. That's really helpful. That really, I think, grounds the conversation. I wonder if we could even take a step back a little bit, just so because I think we're so in the weeds on climate programming, and occasionally, in moving increasingly into climate finance. But I wonder if you could just talk about insurance products. How are they developed? How do the large insurers develop insurance products? What does that process look like?
Yeah, it's a great question, and I'll go through this overly complicated slide, but it's not really. This kind of represents the value chain that brings a product to market and how we approach it. And where you see kind of traditional insurance capital from here up, that is really what the industry looks like. And I'll talk about the bottom two, what we think is necessary to drive the innovation that I talked about earlier. But, insurance and reinsurers, they have dollars, capital stacks that back the financing of claims that could happen in the future. And they put that capital on top of alternative capital and other types of capital like self-insured retention programs, captives, and other people who are kind of, retaining some of the losses for themselves, but also buying insurance. So that traditional insurance layer is a series of like reinsurers and insurance companies, some of which build products, some of which outsource the product development to like innovators, which often can be very small companies that don't have the balance sheets to back the losses if and when they come, but they have the kind of innovative expertise and technology to develop new products. And products are essentially insurance products are a promise to pay. So they are a contract between, and it could be multiple players, but it could be just two players, like an asset owner and the insurer. But essentially, your insurance contract says like if my house burns down or blows away, we get paid this amount based on some sort of trigger. Um, Innovative products can be very sophisticated or actually very simple but differently defined. Like instead of like actual damage happening, there's new types of products like parametric products that say, if the wind speed below whatever, there's maybe a performance guarantee gets triggered that, supports the revenue streams of like a wind farm. And then effectively, products are not enough to get things in the hands of people. You also need distribution. And we think that all these things, kind of the typical distribution is somebody with an insurance product sells through an agent or broker to an individual customer with an individual asset or exposure to risk. We think all of these things can be innovated. You can have new products like micro insurance or parametric insurance. You can have new distribution like community embedded insurance, which we're going to talk about in a little bit, which is like a group purchase of insurance like an employer would do. The other thing that, yeah, go
So
ahead.
just quickly, just jumping in there, with regard to the product development, these insurers, they're looking at actuarial data. I was wondering if you could talk a little bit about data needs, just briefly. I think we've had some conversations around the need to better understand, for example, liabilities associated with, conventionally built buildings versus high performance buildings. Is access to data a challenge for insurers that want to develop more climate sensitive, if you will, products?
Yes, absolutely. Data is to put a price on risk, you don't need to understand the profile of the frequency of the event that you're trying to kind of insure against, the severity and the cost, which is the cost typically. And there's all sorts of event you need, depending on how you design the product, but there's information about what could cause the loss, like, which could be a number of things, but, hurricanes and fires and hazards, but also, there's technical risks that you could be insuring against that have different types of triggers. There's also, as you're kind of looking at some of these climate issues, there's this time horizon issue. Like we kind of know very well, go looking backwards, but looking forward might be a whole different scenario because of climate change and the impact of climate change. So there's forward looking, like what is going to happen based on the current models, and then, especially in most insurances 1 year, but we've identified, and the world has identified that, like, to make insurance more certain, we need to be able to do this over a longer time horizon, so looking forward. And all these things require data. And to your point, the second tier, like one of the things we really think, there's a ton of innovation going on the energy transition. There's more innovation going on related to insurance products for kind of climate technologies and people impacted by these climate issues. But one of the things we think needs to happen is, one, the innovation efforts need to be more closely integrated, because if you're integrating the risk transfer and the risk management at the same time you're innovating the technology, you can incorporate things into the technology that reduces the risk and makes it more insurable. At the same time, you're collecting data and getting better insights about how the technology could or will work, which makes it more insurable, which makes it more easily to unlock finance going forward.
Understood. And I think that I won't get ahead of you because I think there may be a good example of that in at least one of the awardees from your prize, like a very concrete example. So maybe we'll get into this. But you referenced catastrophes. So let's dig into that a little bit and talk about what's happening in the industry right now. We're seeing rising claims, rising premiums, rising non-renewals. Several states are struggling with their the kind of the property insurer of last resort, and identifying funding for those. There was some very good coverage in the New York Times, I think yesterday, about some of this. And yet government-backed mortgage lenders like Fannie Mae and Freddie Mac, which guarantee about 70% of mortgages on single-family homes, still charge the same fees for private mortgage insurance, right? There still are not making a distinction between insuring a home built in, for example, a wildfire-prone area and one that is not. So a lot of challenges in the industry right now, and I'm wondering if you could talk specifically about community-embedded insurance in the context of the California wildfires, for example.
Yeah, I'm gonna quickly go through some of the actual programs, and we'll come back to this, but I did want to highlight, you talked about the prize, we'll talk about that later. Community embedded insurance is kind of a product development and a distribution development that I'll talk about in detail. In our world, that often it gets coupled with what we call the total cost of risk, which I'll talk about first, because you can't create community embedded insurance without understanding the total cost of risk across a community, or understanding the total cost really helps. So one of the things we're trying to do is create a simulator that gives community leaders insight into the total cost of risk. And the total cost of risk is exactly that. And what we're and the inputs into total cost of risk are loss costs, and specifically what is retained by the community. So that's like opposite of what the insurance industry does, but it's the like the uninsured. The people who are uninsured are the aggregation of all the deductibles. So the ones that are retained, the losses that actually flow through to the community that are not insured elsewhere. Investments that are or could be made into adaptation. So, we could spend money to invest in things that reduce our losses. There is a cost to that insurance that I said was covered everywhere and not included in those retained loss costs. And then if something happens, there's costs associated with response and recovery. Those add up to the total cost of risk, which then gets distributed to a number of different people, including individuals in the community that maybe don't have insurance. Governments are often the insurer of last resort, like you mentioned earlier. Insurers do pick up the insurance and other risk takers. Some of it potentially flows through to the banks, like you alluded to earlier. And then philanthropies also come in when there's a catastrophe and have to kind of fund some of these. And the reason all this is so important is if you step back from the individual asset owners buying individual insurance for 1 year and think of it as not just an insurance purchase, but how do we finance these over a longer time periods, understanding how those costs are coming through, who they land on, how they are changing based on like climate change, then informs a more holistic approach that we call community embedded insurance, which is to say, hey, we can transfer this risk at a community level, which is like a distribution or a purchase innovation. We can leverage the purchasing power or the financing power of the whole community to do things more efficiently and effectively. But we can also use those same insights to kind of prioritize adaptation and understand trade-offs between, like, do I build the $1 billion seawall or do I build the $300 million nature-based solution that maybe gives us money to then subsidize purchase of insurance? So you look at it more holistically across all risk management, and you can look at equity issues. You can look at kind of how to prioritize things sequentially over time. It just provides an approach to managing risk at a community level, which often could include the group purchase of innovative insurance products by the community and embedding them in things like your tax payments or other things. So we think this is a way to drive a lot of the innovation from the demand side, from the people who have the risk and own the risk. They can drive innovation up that value chain that we talked about, as opposed to just always insurers driving it down from the supply side. And we do have a number. You talked about wildfire. We have a number of projects. We were working with the California Department of Insurance and Cal Fire. We were actually supposed to go out to a meeting next week to do some planning around how they could do a group purchase, but obviously they're a little busy right now. But so there's a number of pilots that we are working on, and a lot of them are in the community planning stage. We're working with some communities in Southwest Virginia around riverine flooding. We're working with California on wildfire. We're working with Honolulu on just doing a kind of a disaster kind of resilience plan for the city and county of Honolulu. And we were starting to working with Salem, Mass to say, how can we do a home resilience audit and then capture the value of any improvements that homeowners make, really based on the Mass Saves energy audit. So we want to call it Save Mass, and think about it from the resilience and the coastal flood perspective.
That's great. Thank you. So to be clear with these, if community embedded insurance takes off, would these communities still rely on a reinsurer?
So it's very it's a great question. We think that the reinsurers will still provide a lot of the capital. The catastrophe market's about 50% of all catastrophes on average are uninsured. So a lot more capital is necessary. And we think that comes from another number of different areas. One, we think a lot of people, whether they know it or not, whether it's the community or the individuals, are significantly self-insured. That large, a protection gap is essentially self-insurance. You're insured whether you know it or not. You're taking the risk, and that could be local communities and local governments bear a lot of that risk. We think that capital needs to be innovated, which requires kind of regulatory innovation as well. But one model that we see that could fill the gap, which doesn't exist in insurance, but is very prominent in the is community development financial institutions. So CDFIs are really tight, they are connected to the communities and they lend, they lend on a business model that needs to be profitable, but they also focus on impact goals. And that kind of type of model, there are 1,500 community development banks, all with different models that are all impact focused in one way or another. There's going to be one insurance company that is focused on that type of model, emission driven reinsurer, and it's called Greenie Re, and it was funded by the Greenhouse Gas Reduction Fund. It's in the process of being set up, and they can provide capital to back some of these innovative products, and they can do it more effectively and efficiently because they are often specialized and closer to the communities or the issue that they are trying to solve, the problem that they are trying to solve.
Okay. And I think you got at this a little bit, but I think it's worth leaning into or hovering on a bit, which is to say that because community embedded insurance it's just more localized, right? It's more local and regionally specific and can be more sensitive to the needs of a region versus, I think the insurance industry that we have now, where you've got carriers that operate regional or even nationally. And so I'm exposed with my insurance to risk in Florida, despite the fact that the insurers deny that this happens. Many have confirmed that, in fact, yes, that is in fact why premiums are going up in Massachusetts, not necessarily because of, not exclusively because of risk here, but because of claims elsewhere. But it does make me think that there's more of an opportunity to develop, and again, you got at this a little bit, but innovative approaches. You could be more sensitive to, for example, providing premium reductions, for certain properties that meet certain standards, or as you know, to make investments in adaptation infrastructure in a way that I think we just wouldn't see with kind of the conventional insurance industry.
It is very difficult for a large global reinsurer to capture the value of local projects that bend the cost curve, that they don't really understand. And there's 19,000 municipalities in the United States, and like companies, the large global reinsurers that have 40-50 billion dollars worth of assets, they have difficulty, if a local community leader says, hey, we did a $50 million coastal restoration and we know that it reduced the risk by this much. The big global carriers are focused on risk reducing or changing things that are like, rain in the Northeast United States is going up by 40%. And they are trying to model that data. So when it gets to hyper-local data and hyper-local projects, you're right, local kind of connection is key. And that's why we think a model based after like the community development financial institutions, but community development reinsurers would at least connect them. It might not solve all the problems, but at least the discussion is about what's going on locally, which is often the risk data.
Okay. Well, I don't know if it makes sense to hover on the wildfires anymore. Maybe we've spent enough time in that dark zone. It's obviously awful, but it will continue to be a real serious challenge for the insurance industry. Maybe it makes sense to pivot to something a little bit more upbeat. You just announced the winners of Insure's Insurance Innovation Prize. 8 winners, right? Including Massachusetts-based Energetic Insurance, which, as you note, has been supported by MassCEC, and in fact, was co-founded by a MassCEC alum. You awarded $5 million to your 8 winners to develop solutions that fill insurance gaps in the energy, I believe the energy, buildings, and transportation sectors. So we'd love to hear more about the competition and maybe some of the winners.
Yeah, I'll give you like a real short on the prize was, like you said, $5 million pool. With at least 5 minutes, we ended up giving it to eight submissions. It was actually 9 companies. One had a joint submission. And it was for companies that submitted proposal to develop an in-market insurance product that they could deliver within 18 months that would essentially accelerate the adoption of either clean transportation, clean energy, or clean buildings, or provided some sort of innovation that cut across those categories. And it was super exciting. The companies were a joint submission from EcoStrat and New Energy Risk to provide performance guarantees around biofeedstocks for the bioeconomy. Energetic Capital and KWH Analytics provided 2 different types of tax credit insurance to make especially the smaller tax credits and the smaller developers more able to transfer the tax credits, sell the tax credits. EV Star provided insurance, a warranty product for EV charging stations, which I guess in a lot of areas are like 19% of them are down because of some sort of problem with the charging station. Exante is a parametric product that provides a sunshine guarantee for small consumers of solar, so that if they are worried about the revenue that they're going to get because the sun doesn't shine, they can be insured against that.
And Charlie, could you just quickly, for the uninitiated, can you just quickly define what a parametric product is?
Yeah, sorry for the kind of
That's okay.
ballpark lingo, but yeah, parametric products. Most insurance products have a trigger that is some sort of cause of loss, and there is a adjustment of the loss damage that says that this is what you get paid. It's the combination of the two. Parametric insurance policies are triggered by a performance metric. So wind speed, in this case, it's solar irradiation at the project site or wherever the solar panels are. So they have and most parametric products are triggered by some sort of third-party reliable data source. So they are tracking irradiation at wherever their kind of locations are. And if the irradiation falls below or is above, however the trigger's set, if it's below a certain level for whatever the period of time is, it will automatically trigger a payment. So nothing needs to be done. There's no filing of claims. It gets money out very quickly. And these parametric products can be done for performance guarantees, things that are kind of weather related, a lot of things. It is really a new type of insurance in some respects, but in some respects, life insurance is a parametric. It's like it's triggered by you're not alive anymore. That's the metric, essentially. Um, so yeah, that's what they're doing. And Sonerium Labs and Talarna also have some parametric products embedded in theirs. Those are also all risk, so they cover more traditional type insurance, but for different types of energy assets, including solar, and Talarna is focused on energy storage battery products, including kind of larger ones. And then finally, Luminar is a LiDAR company that is installing, which is light. Um, Actually, it's kind of like light radar, essentially. They put them on the vehicles, and they are some of the technology that and they're installing these on EVs, but they're kind of autonomous vehicle type capabilities that are like crash avoidance. So they actually reduce losses, and they are embedding insurance into their technology products that they are selling to the EV manufacturers. And they think they can reduce the cost of insurance by 30-40%, which should accelerate the adoption of electric vehicles.
Maybe more meaningful than the good student discount, right? That I think some,
Yes,
right?
exactly.
The actuarial data, I think, will support the
Yeah.
LiDAR application
And,
over the
and they have
performance.
they are a little bit further along than some of the other ones. Some of them are brand new products. They definitely have some of the data involved that they've kind of showed it, and they'll be rolling into market in some states in I think the first or second quarter of 2025 through partnerships with, I think Volvo is their first customer.
Great, not surprising given their track record. So
Yep.
this prize is wonderful, Charlie. I'm wondering, just before we pivot to the next topic, and so glad that you've launched it. We were happy to talk to you about it in the very early stages, and we look forward to ongoing collaboration with you all. I'm wondering if this is, might this might this force some good conversations in the C-suites of major insurers? Do they need to launch their own skunk works? Do they need their own in-house innovation shops? And do you see that happening?
I think it's an individual question, company by company, but it does drive innovation in multiple different ways. One, it provides the larger carriers that are slower to innovate a roadmap to follow. Two, it puts out startups that are doing the innovation that the companies, all these companies, insurance products, unlike other innovative products, you need to raise money twice. You need to raise money to develop the product and all the things that every company needs to do to operate a business. But then you need to get risk capital because you can't just sell insurance if you don't have a balance sheet to pay claims in the future. So companies need to go to the large carriers to access risk capital to back their loss reserves. And the innovative prize, the prize competition, the involvement by NYSERDA in promoting it, and kind of we did a lot of government roundtables, we did industry roundtables that unlocks capital from the carriers and reinsurers to back these companies. But then it also creates a pathway for new companies to, do the same thing. Once you do one, we're confident that hopefully these will be successful. And some of these are, you talked about energetics already. They're more than a startup. They're still kind of fairly young relative to billions of dollars of insurance companies, but they have a track record, and the more we put track records, help these companies kind of get a track record, the easier they are to invest in both operating capital and risk capital.
Thanks. No, that's very good to understand. The raising money twice piece, that's important, an important detail.
Yeah.
So pivoting to, we've talked a lot about the industry, and I think this will, I think, be my last question before we turn to, I think, hopefully some audience questions. But within the energy sector, we often like to say that if we want utilities of the future, we need utility regulatory frameworks of the future. So is it fair to say in this industry that if we want insurance companies to better integrate climate risk, of course, that will require leadership from the private sector, from major insurers, but it occurs to me that it will also require new approaches to insurance regulation, and that is largely state driven, state regulated. So I'm wondering if you could talk about what climate sensitive kind of insurance regulatory 2.0 models need to look like. And uh,
Yeah,
yeah, what's the historic role that insurance regulators have actually played in the industry, and how does that need to change?
I mean, it's a really great question. You can't innovate unless you innovate. You can't innovate the system unless you innovate all parts of the system. The innovative, the historical role, I'll start with kind of your last part of the question first. The historic role of regulators has been to, one, you need to ensure their prices are high enough so that companies don't go insolvent, because if a company goes insolvent, then all the, losses that they potentially are backing in those contracts, promises to pay are worthless. And so they need to make sure one of their missions is to make sure the industry is solvent, which is important. The other one is they want to make sure that consumers are not gouged and, taken advantage of by companies. So those are two competing goals, and it requires, monitoring a lot of data and, regulating products as they come through. But one thing that historically has not been a mission is to take any action to make sure that adoption is high enough so that people are insured to essentially manage the protection gap. They do create, the states do create these insurers of last resort, which are, often called the residual market. And the residual markets work really well when the residual piece is 2 or 3 or 5% of the market, and they are residual. And if there's an excess loss, it gets spread out among everybody. But in many states, and including in Massachusetts on the Cape and Islands, I think the residual market for kind of hurricane losses is creeping up to 35 or 40%. And when it gets large like that, the economics of the market don't work. And what happens is, like, the industry is kind of exiting, and I think the question is might be related to that, which we can talk about. But residual markets don't work at like 35, 40, and certainly in Florida, sometimes you see like 65%. So that's not a residual market anymore. That's the market, and the actual kind of private market is the residual market. So they need to reorientate themselves, the regulators, to how do we manage, the protection gap, and that requires, maybe putting funds into some of these community development reinsurers to promote innovation through MGAs that actually close the protection gap. And so those are some things. Also, like new products, like parametric products aren't traditional insurance. They are really derivatives, because you're triggering a payment based on a metric that works like insurance. So that's a derivative. So they need frameworks for regulating some of these newer products that they don't necessarily have in all states. Um, so I think the innovation efforts around kind of regulation and kind of state involvement definitely needs to innovate along with all the other pieces of the value chain.
And the residual market, to be clear, the residual market, the insurer of last resort, is it true that those are essentially funded by the large insurers?
So it depends on the state and the details of the state, but usually there is some backing from the state. But if you trigger some sort of excess, the excess loss, like this California wildfire is probably going to trigger an excess loss that then would cascade to the participants in the market based on their market share.
Hmm,
So, if you have 50% of the market, you may get 50% of the excess kind of surcharge, whatever that might be.
got it. Thanks, Charlie. Well, this has been incredible. A couple things. We've got a little over 10 minutes left, so I do want to pivot to some of the audience questions. I also want to remind folks, and I also want to acknowledge Michelle on our team and Elizabeth on our team. who helped put this together today. And I think Michelle is going to launch a couple polling questions that you should all be able to access. I think it's the More button at the bottom of your screen, and you should be able to pull up a poll. So certainly let us know if you're not able to do that. Looks like it's appeared. So there's that. But why don't we now turn to some of the questions? So actually a question from Emily, a great question. Can you summarize the top 3 areas where innovators, new ventures in the insurtech space should focus at this time? And I know that you that part of the challenge that you launched, or the prize, I remember having this conversation with you months ago, where the early steps are kind of identifying what are some of the challenge areas and opportunities. And you kind of begin with that question, and then that somewhat leads into this
Yeah.
one, which is what are the exciting areas where there's
So
opportunity?
I'll answer 2 different kind of frameworks. One is, I think if you look down that value chain, I think what we really need is new products, like parametric micro insurance, a lot of different things, and new distribution. So group insurance is one example that I talked about, but also you can embed insurance, kind of like the Luminar example is. They are selling a technology. They're a large company that's a technology provider, and they are embedding insurance is included in the technology. So those are 2 areas that I think. And then again, on the value chain is, I think, coming up with new ways to back these things, capital, like where does capital, the backing capital come from, public-private partnerships, which is the kind of community-driven reinsurers. And then you can also look at it by technology or hazards. Clearly, wildfire is a challenge. Clearly, flood is a challenge, which I think the first question alludes to. Clearly, the innovation, speed of innovation in the energy transition, insurance not keeping up with it. Those are all areas that require R&D and innovation.
Great. Thanks, Charlie. And yes, so you did refer to the first question from Jim. I feel like we're on radio, right? The question from caller Jim.
Yeah.
But I think a question that frankly is on many people's minds, which is that there's frustration that insurers, and to be fair to the insurers, likely supported by regulators, that they are insuring properties in places where there's extremely high risk. And so kind of more of a general question about the insurance industry and that particular challenge. What's the best response to that question? How do you see that space evolving? The flood insurance program is in deep water. Sorry, right? So what are the right solutions there?
It very much like the energy transition. It is not like a once and done thing, because Jim is exactly right. He's saying, like, should we really be just insuring people, having them build back in the flood zone and then pay again, and incentivizing behaviors of people living in, areas that, quite frankly, some areas we should not be living in. But on the flip side, you can't just, like, it's probably 100 million people that maybe need to either kind of invest significantly in their built environment to make it, risk-free or lower risk, acceptable risk, or potentially relocate. So that is very much like a transition challenge. Like, how do we get from where we are today to where we need to go? And what we think is, like, well, at least digging the hole. We need to stop digging the hole right now, which is one of the reasons we really promote, like, local insurability kind of planning being embedded at the community level, because local community leaders, they understand land use and they control land use issues, and a lot of these risk issues are related to land use, infrastructure, and building codes. And having, like, insurability as a separate thing that isn't driven by those same community leaders is what causes a lot of this kind of, like, hey, we're building here. Economic development is like, we want the tax base to be big and profitable and drive revenues. And that means building on the beach and building by the river and all these things and building cheaper so we don't have to do all these kind of things that we should do. But if you incorporate this kind of total cost of risk concept and say, well, what is the total cost of building on the beach and building here? And then we think local decision making that incorporates all of that will lead to better decisions across the whole kind of range of possible decisions. And it would lead to building codes and regulation and things that just have a much healthier kind of overall kind of resilience approach that kind of balances the trade-offs between investing in adaptation and risk reduction and transferring risk.
Okay, now that makes sense. Well, not seeing any other questions, I do have one about the link between, particularly in the built environment, but of course you could loop in the transportation sector as well, and thinking about locally or regionally focused insurance. Of course, we have enormous and rising health insurance costs, and I'm wondering if you could speak to either innovative policy work in this space or insurance innovators that are looking at these linkages between both indoor air quality and outdoor air quality as we think about building electrification, getting natural gas combustion and stoves out of buildings and boilers, improving that indoor air quality that ostensibly would lead to better health outcomes, and thinking about the cost of public health. When can we talk about the linkages there? I think that there are some states that are beginning to think about this, and that doctors are beginning to prescribe building decarbonization, thinking about the public health costs that are related to poor indoor air quality.
It's a great question. I think it's an opportunity for a lot of innovation in both the financing of these risks and also the efforts to make people more healthy. And I think the opportunity is historically and often based on just the ability to assess risk. Typically, there's some big drivers of risk, things like obesity and smoking and general just poor health, which kind of swamp the ability of a lot of other things that do contribute to better health. But as like data sources improve and analytics and AI tools become more advanced, there was ability to kind of start to looking at very small drivers of risk, but aggregating them up in ways and at community levels that look at things like you said, indoor air quality, things like food security, food kind of availability. So like things like kind of micro farms and local kind of where stores are. So I think what you're going to see over time is instead of like the risk models being driven by a handful of very large drivers of risk, those will still be in there for sure. But the innovators will then be able to say, yeah, but we kind of aggregated up these 500 different community factors, and then we're working with a community to kind of move all these micro levers, track them all, and then see and track the kind of risk reducing benefit and capture the value of all those small changes, but on an aggregate level can be very significant.
All back to data. We'll need more
All back
data.
to data,
Right, to
exactly.
build better insurance products that are more
Yeah,
climate sensitive, we're going to need
yeah.
access to data, which is also a change in the energy realm, right, on the grid. In order to operate the grid more efficiently, we need more data. So at least one linkage there to our work. So we're just about out of time. I just want to remind everyone of the poll. So please answer the questions in the poll. I think one relates to the format of this series, whether or not we want to continue with a webinar or move to more of a podcast, which I think we're kind of inclined to do, but would love to hear your thoughts on that. I'm also going to drop my email in the chat for those who are outside the organization, who don't have access to it. We are still thinking about creative names for this speaker series, so it doesn't remain the MassCEC Climate Tech Speaker Series, but something much more creative. And thank you to all of those of you who sent suggestions already, but would love to hear more from all of you. And then finally, I want to thank you again, Charlie, for your time and this wonderful discussion. It's been really great. I think we've all learned a lot. And we look forward to staying in touch with you in these efforts and following the winners and seeing how they progress, particularly the Massachusetts-based winners.
Thank you. Thank you so much. We appreciate the opportunity to come, and we appreciate all the work that you and the community does here.
Great, wonderful. Thanks, Charlie. And I also want to thank everyone who tuned in today and listened. So we look forward to the next session. The next dialogue will be February 7th. We'll be talking about inclusive utility investment, a novel approach to project finance, the utility-driven project finance, focused on building decarbonization. So we're excited about that dialogue with Ashley Muspratt. So we'll send out information about that to everyone who tuned in today shortly. So thanks again. Thanks for tuning in. Thanks, Charlie. And everybody have a great weekend.
You too. Take care.
Bye all.